Hello, everyone. Thank you for taking time out of your day to listen to our September 2022 Economic Outlook and Investment Strategy. I'm Rob Mextrop, Senior Portfolio Manager here at City National Rockdale, and this is being recorded on Monday, September 19th. Let's dive in. I think this should take no longer than 15 to 20 minutes, but a ton to talk about. The first thing, I'm not going to go through all of our bullet points from our investment strategy meeting, but I've highlighted a couple important ones. One, on the economic outlook, we are more cautious than I think the consensus view right now in the market for the economy, corporate profits, and recession risk. And all three of those things kind of go hand in hand. And then investment strategy, we expect market volatility to remain higher for all asset classes through the end of the year. There's just a ton of news that's going to be coming in almost daily. And you can see each piece of news that gets released, each economic data point that gets released, there's a ton of volatility associated with that. So you can see we just got an inflation read last week. Market took a big hit on that. And we could see the same thing, both up or down, as data comes out. So we're watching everything closely, but we are definitely more cautious, I think, than the average firm right now. So let's get into some of our projections. And we have to start with the September speedometers. And not too much of a change from the August reading or even the July reading, which I think is telling. City National Rockdale was not buying the summer rally that we had. The month of July and August were really good months for the stock market, but we were not believers in that rally, and it's kind of proven to be true. And I'll talk about why that is. Well, a couple of things to start. One is the two green indicators that are still out there. It's funny. These are probably two of the most important economic signals, and they've been fantastic. The labor market has held up incredibly well. We have an unemployment rate under 4%. We have total number of jobs now back at levels that were before the pandemic even started, which is absolutely huge. And consumer spending has shockingly remained high. Despite pessimism from consumers, we still see a ton of spending, especially on services. Think hotels, casinos, sporting events, vacations, leisure travel, bars, restaurants are all at kind of pandemic level highs. And that's been huge, supporting the economy. I get the question a lot, are we in a recession right now? Absolutely not. The economy is way too strong at the moment to be in a recession. Then why is the stock market down 20% on the year? Well, it comes down to the 6 to 9 month forward-looking view. Markets are forward-looking, and the odds of a recession, we think, are very high over the next 6 to 12 months, and we'll get into that. And why is that? Why are the odds high? Well, a couple of things. One, the geopolitical risk situation, it remains tough. Russia and Ukraine, no sign of peace there, unfortunately. That has dragged Europe really into the mess. With Asia, a slowing China has dramatic implications for the entire region. And, when we talk through client portfolios right now, there's a reason why we do not have any exposure to international stocks right now. It's far too risky, in our opinion, to be investing outside the U.S., especially with a worsening economic outlook globally. We have to talk about inflation. Inflation is the number one headline. I mentioned the data point we got last week spooked the market. And what's going on? Well, inflation is still running hot. We have inflation year over year north of 8%. We know the Fed is aggressively raising interest rates to try to bring that inflation down. But what's been shocking is that inflation really hasn't budged. And that's with gas prices dropping 10% month over month. So that's really what spooked the market. It's like, even though we have seen interest rates go up, even though we have seen gas prices come down, inflation remains very high. So what is our opinion of how things are going to play out? Well, one thing we know for sure is look at the monetary policy, which is what the Fed is doing. Look at interest rates, look at the yield curve. The Fed has not really changed anything when it comes to their public statements. They said they are determined to bring inflation down at all costs, and they will continue to be very aggressive about interest rate hikes. We are looking at another triple rate hike for the third consecutive Fed meeting here in September. And we know when interest rates go up, you see the indicator here, all else equal, that has a negative effect on the economy. I mean, look no further than the housing market. I'll talk a little more about housing in a second, but you can see when interest rates go up, home sales start to slow. Same thing goes with auto purchases. I think auto sales are going to start to take a hit as the cost of financing a very expensive vehicle continues to go up. So the question becomes, in my opinion, is not a question of whether inflation will come down, because it will. The Fed is going to be as aggressive as they have to be to get inflation down. The question is going to be, how much damage is the Fed going to do to the economy to fight inflation? How bad is a potential recession going to be? I think that's the question everyone needs to answer. I'll get to it in a minute, what our opinion and positioning is. But first, let's take a look at some of our updated projections. And since we're closing in on the end of the year, I'm going to focus more on the 2023 year-end estimates, because I think these at the moment are probably the most important when positioning a portfolio right now. So first, let's look at GDP and corporate profit growth. And notice that the 0% number is in the lower range of both of these numbers, meaning that we're projecting, if things tend to go toward the more pessimistic side, we could have a year with absolutely no growth. And that could include a couple of quarters where we have negative corporate profit growth and GDP growth. But then notice inflation. CPI comes down to 3-4%. So that's exactly what I mentioned before, meaning that we think inflation is going to come down in a hurry next year, but it could come at the expense of GDP growth and corporate profit growth. And this is one of the reasons the stock market is down close to 20%. This is kind of being projected that corporate profit growth is likely to slow down significantly or potentially go into the negative territory. Now, finally, interest rates. Very important to try to project where interest rates are going, and very difficult. One thing we know is the Fed funds rate is going up. The Fed is going to raise rates. In fact, just with the latest data that's come out last week, I will take the upper range of both of these Fed funds numbers, meaning that we're likely to hike a little more than the average consensus view was just a couple weeks ago. And we talked about the effect of those interest rates going up. Now, notice, though, that long-term interest rates, we actually have projected to be lower than short-term interest rates, meaning that the 1-year, 2-year bonds are actually going to be yielding higher than a 10-year bond. That's what's known as an inverted yield curve. Typically, that is a sign of a recessionary environment whenever the yield curve inverts. So just another factor that says recession is possible or even likely in some ways. But whenever you have this yield curve imbalance, it's very important to position your bond portfolio strategically, meaning that you don't want to be out buying 10, 20, 30-year bonds at a time when the short-term interest rates are paying more than the long-term interest rates. You're exposing yourself. In fact, your returns would be very poor this year in bonds if you extended yourself that far. Now, the key for us is trying to buy bonds to take advantage of the higher short-term interest rates. And that's one of the things you're going to see in your portfolios is you may see a little more in conservative assets. It's the only good thing about the Fed raising interest rates. We finally can get paid to invest conservatively. And I think that is going to be good news, especially for more conservative clients that may not want to be 100% in stocks. Now, the next slide is one you may have seen before because it's been in our decks a few consecutive months. But I think this is the question we're all trying to answer. We know the U.S. economy is in decent shape now, but I just talked about it. The Fed is going to bring us down. There's no question about it. The question is, where do we land? We have the two green arrows or green lines that represent the soft landing, and the orange and red line that represent, what the Fed would call a hard landing, meaning the economy goes into a recession. So we actually haven't changed our view much at all in the last couple of months on this, even though the market keeps changing their view. Our view is that the mild recession and slow growth are the most likely scenarios. And if I had to pick one, I'm choosing the mild recession as the most likely scenario, meaning our economy goes into a recession, but it's not necessarily a long one or a significant one. And I think in a mild recession scenario, stocks should be down in the 20 to 30% range at their worst. And that's kind of where we are right now. That would be another 10% downside maybe, but in this mild recession scenario, there are some good buying opportunities. So kind of summing up the strategy right now, mild recession, very likely possibility. Quality stocks do very well in this type of environment. You want to position your portfolio US stocks, avoid the international stocks. Quality companies, profitable ones, strong brands, those are the companies that can ride through a trickier time. You don't want to be out buying the more aggressive tech stocks, despite them getting hit so hard this year. Could be more pain ahead there. So I think I cannot stress this enough. You want your portfolio to be focused on quality. So that said, I do have a couple interesting slides for some more economic data. So if you're interested in going into the weeds a little more, these next slides are for you. I get a lot of questions about consumer spending because it's been incredible. Despite all of the issues going on, consumers continue to spend a ton of money. But look at household net worth here on the left. This is the percentage change in household net worth. The blue line represents, where it's gone. So it's just starting to flatten out. But look at the dotted blue line. That's the average of the last 5 previous recessions, meaning that consumer household net worth is so much higher in terms of the growth rate than any of the previous recessions. And that's one of the reasons spending has maintained. But look at the wage gains that we've had. This is an ominous sign going forward. Now, if you just look at the black line, it shows that wage growth right now is around the 5% level, just starting to come down. But when you take into the account that inflation has been running 8-9%, wage growth is not keeping up with inflation. So the red bars down here, it shows that the average person is losing about 4% in purchasing power and has been losing over the last few months. So that starts to add up. And then the question becomes, will consumers remain resilient? Because that spending has helped companies maintain profitability. It's helped keep the economy out of recession. But we think consumer spending is going to start to drop. The blue line, the dark blue line here is consumer confidence. So consumer confidence is at the lowest level we've seen in years. People are not confident about the state of the economy. But look at the light blue line. Consumer spending has remained strong despite the drop in confidence. One of the reasons spending has remained strong is excess cash in the market. Now, another ominous sign, if you look at this chart to the right, is this shows excess cash per household in different income quintiles. You'll see the top 20%, the top 40%, even the top 60% of Americans are sitting on a lot of excess cash right now. And that's helped, continue to fund the services spending, the vacations that we've been seeing booked over the last few months. But notice now how the bottom 40% of Americans, especially the bottom 20%, their excess cash is basically gone. And that starts to have a hit, especially when you look at what helps the economy grow. It's consumer spending. And when you have disposable income to spend, that makes it much more likely the economy is going to grow. And you really start to worry about the bottom 20, bottom 40%, that they're really going to pull back on spending, which hasn't happened yet. So to answer this question, will consumers remain resilient? I think you're going to see consumers start to take a hit, and that's part of our outlook. And then, housing, we talked about this a little bit. Look at the right side of this page. The 30-year mortgage rate is back to 6% again. You haven't seen this since before 2008. That's going to have a real impact on the ability to, sell and buy homes right now because housing costs, housing prices haven't dropped very much. You see single-family home starts or home builders are starting to react to this. There may not be as much demand for new construction, but housing costs have only started to decline. This is the percent change in both home ownership and home rental. We're still looking at very elevated levels. There's room for this to go down. In fact, rents have been stubbornly high. It's actually one of the areas that's had inflation. So I think the housing market is likely to continue to contract over the coming months when rates stay this high and the economy starts to slow. But it may take a little bit. It can take time. So when we talk about inflation, I think that is one of the key stories. What is inflation going to do? Notice we have a 7.5% number through the end of the year. So this gray line is our forecast for inflation. So that's still a high number by year end. But we do think those Fed interest rate hikes are going to start to have a major impact early in next year. Look at how this gray line starts to collapse. And again, what are the two things that have kept inflation high? Well, it's been those two green indicators. The labor market is good. Wage growth has been decent enough to give people money to spend. And consumer spending, especially in things like transportation and food and recreation, apparel, has been strong enough to keep prices going up. When those wage growth numbers start to fall, when those consumer spending numbers start to fall, it's going to be very, very hard to have inflation stay at these high levels. That's why I'm so confident that inflation is going to fall. And I mentioned it, wages are the key to the inflation outlook, because look how tight the labor market is still. There's fewer than one person available for every job opening. So since the labor market is so strong, it's going to take some damage to get the labor market softer. And where that damage is going to come, it's going to come from corporate profit slowdowns. So you've already seen a slow change here. Wage growth is starting to slow down. You see some big companies like Apple and Google and Microsoft say, we're going to slow down on hiring, but it takes time. I think you're going to start to see not necessarily a massive amount of layoffs, but you're going to start to see companies not offering the big pay packages to attract talent. You're going to see that wage growth start to come down. And when that wage growth moderates, I think that's when you start seeing inflation cool down. So it'd be interesting to see. But the fact that this labor market is so strong, I think that's one of the reasons this is not going to turn into a 2008 or major recession. Because if wage growth goes down to 2% again and unemployment goes up to 4.5, 5, that's not the end of the world. That's consistent with the more mild recession that we're looking for. So I'll wrap things up and just kind of give you something that we did get right. This is always on our playbook, that bear markets, and a bear market is when the stock market is down 20% or more in a given year. Bear markets are almost always followed by some big rallies in the middle of the bear market. And notice all these different dates. We've seen a S&P 500 return of 20%, minus 20% or more. During these times, we've had significant rallies only for the market to go back down again. So we've actually seen a very similar situation this year. We hit 23% down. The market rallied back 13%, where we were only down 10% on the year. And now we're close to testing the lows again. So again, I mentioned this at the start. We were not buying into the rally. In fact, we were actually being very conservative as markets rolled back and still remain conservatively positioned in the accounts. So hope this was very helpful. Again, summarizing everything, mild recession, very likely scenario. Portfolios are more defensively positioned, although we still are comfortable in quality stocks. And you may see additional investments in traditional bonds that we were very sour on 12 months ago, especially shorter duration ones that are paying us more in interest. So thanks for listening in. Hope to do this again soon. Everyone have a great rest of their day. Bye-bye.